Today, we are diving into one of the strangest moments the stock market has seen in years. Prices are hitting new highs, confidence is soaring, and on the surface, everything looks incredible. But underneath that excitement, the foundations of the market are beginning to show real cracks. If you feel like something about this rally does not add up, you are not imagining things. There are real structural issues forming, and ignoring them is the biggest mistake investors can make. Let us start with the job market. For the last few years, it felt unstoppable. Companies were hiring quickly. People were switching roles with ease, and wages were climbing. A lot of that was driven by cheap borrowing and the massive burst of post-pandemic demand. Businesses hired ahead of long-term growth, assuming the boom would continue. But once rates went up and stimulus faded, reality settled back in. Job openings have been falling. Unemployment has started creeping higher, and people are becoming far more cautious about leaving their current roles. At the same time, companies are turning to automation and AI to do more with fewer employees. Even if the economy continues to grow, hiring may never look like it did a few years ago. This matters because consumer spending makes up the majority of economic activity. When people feel insecure about their income, they pull back. They eat out less, travel less, and avoid big purchases. Once spending slows, corporate profits begin to weaken. And historically, the stock market reacts to that, although often with a delay. The problem is that most investors are waiting for a dramatic headline, a big crash, a financial crisis type event. But the truth is that many market turning points happen quietly. Fundamentals deteriorate slowly, valuations stay elevated for too long, and eventually the mismatch becomes impossible to ignore. This brings us to a scarier combination, forming beneath the surface, slowing growth and rising inflation at the same time. It is the early signs of stagflation, one of the most difficult economic environments to navigate. Prices are rising, yet job losses are increasing. Usually inflation cools when the economy slows, but right now they are rising together. That creates pressure on households, businesses, and central banks. If banks cut rates to help the job market, inflation could accelerate. If they raise rates to control inflation, unemployment could get worse. It becomes a no-win scenario. On top of all this sits the issue of government debt. Some countries are running massive deficits year after year, and interest payments alone have become enormous. Imagine carrying a giant credit card balance and only paying the interest each month. That is essentially what is happening at the national level. As populations age, healthcare and pension costs rise while the working-age population shrinks. Revenue struggles to keep up, spending keeps increasing, and deficits widen. This is not an immediate trigger for a crash, but it raises long-term risks and limits policy flexibility when the economy hits turbulence. All of these issues matter, but none of them are the core fuel behind major market declines. The real gasoline in the room is valuation. Stocks are priced extremely high relative to historical norms. Whenever markets reach these levels, long-term returns tend to fall sharply. Periods of heavy overvaluation have historically been followed by a decade of weak or even negative real returns. You do not need a crystal ball to understand why. When you overpay for an asset, your future return is simply lower. The company must either grow much faster than expected, or the price eventually adjusts downward. It is simple math. The challenge is that no one can predict exactly when valuations will correct. Prices can stay inflated longer than anyone expects, but that does not change the long-term outcome. Overvalued markets eventually revert to more reasonable levels, whether through falling prices, rising earnings, or both. As investors, we cannot control when that happens. We can only control what we choose to pay. This is why understanding the difference between price and value is so important. Price is what you pay. Value is what you get in return. Most people focus on price because it is fast, emotional, and always changing. But value is more stable. It comes from the business itself, its profits, cash flows, competitive position, and long-term strength. When you focus on value, the short-term ups and downs of the market stop mattering as much. If a stock drops but the underlying business remains strong, that is not a crisis. It is an opportunity. The goal is not to time the market, predict interest rates, or guess what the next headline will be. The goal is to build a system that works in all environments. A system that allows you to stay calm when the world feels uncertain. A system that focuses on buying great businesses at reasonable prices and ignoring the noise that distracts so many people. So should you invest at all-time highs? It depends on what you are doing. If you're dollar cost averaging into broad, low-cost index funds, then yes. That habit matters far more than short-term movements. But if you are buying individual companies, you need to be selective. You should not buy just because the market is going up. You should buy when the value of a business is meaningfully higher than the price you are paying. This is the mindset that separates real investors from speculators. Real investors look past the excitement. They look past the fear. They study businesses, understand value, and make decisions based on long-term outcomes rather than headlines. In a market full of noise, this is what keeps you grounded. A great story can still be a terrible investment if you pay too much for it. A boring company can be an excellent investment if you buy it at the right price. Once you truly understand this, the market becomes far less stressful. You stop chasing hype. You stop panicking during downturns. You start recognizing opportunities that other people miss. We are living through a moment where the headlines are loud, the prices are high, and the risks are rising. But with the right principles, you can navigate this environment with clarity and confidence. Focus on value. Focus on price. Focus on the long term. When the market eventually resets, you will be ready. And when others panic, you will see opportunity where they see danger. **, disclaimer: this article is for informational and educational purposes only and does not constitute financial advice. Up Education is not a licensed financial advisor. Please consult a certified financial professional before making any investment decisions.